So, really jumping in because we have a short time. The FDIC recently joined with the other prudential regulators to come out with guidance, which in banking we think of as you got to follow, even though it's quote unquote guidance on third-party risk.
There you go.
And so it talks about guidance on third-party risk for the life cycle of the relationship, and it talks about follows the OCC's lead on critical relationships. So I guess the starting point is, what do you think of that from the fintech perspective and the banking perspective on this new guidance?
Yeah, so I both have concerns about that guidance and a question mark. The reason being is that when you read the guidance, it says a lot, but it doesn't say anything to really help you understand if I cross the line, where's that line? How far can I go with just about anything? And so I think, and it doesn't matter politically where you stand or what you think about the fintech partnerships, et cetera, et cetera. I'm assuming this crowd is very friendly to them for banks. But the truth of the matter is banks need to know how to comply. And if you don't give them the road lines, stay within the lanes, they actually will be hesitant to engage in partnerships. And so I do think that's what...
And Governor Bowman, who dissented, which is a rarity, made that exact point, that were the lines on this. How do banks comply?
Yes, and Governor Bowman is a good friend of mine. So it's one of those things that I think if you look at the guidance, it says a lot. There's a lot there. But as a former general counsel of a bank, I would be taken aback by explaining to my C-suite, what exactly does this mean? You know, where is that line? And how do we follow? And let me tell you, as a former GC of a bank, if you don't know how to do it, you don't do it. So, and that's what I'm afraid is going to be the chilling effect of the guidance. And then there was a second question there.
So what do you think philosophically this means? I think whenever the regulators come out with rules or guidance, bankers on one level think, well, they're trying to run us out of the business. Do you think that's what's going on? Michael Hsu at Money 2020 recently said he thinks banking as a service is here to stay, but he said if you're taking more risk, you have to do more.
I do believe that banking as a service is here to stay. I think you're going to have, troubled waters, dire straits for the next couple of years. And then both the industry and the regulators will adjust, because I do think for a number of banks, we're down to about 4,700 banks in the United States, and a lot of them are very, very, very extremely small. And they simply don't have the capabilities, the technology, the economies of scale to develop new products and services. They have to partner up with fintechs that do in order for them to stay viable and stay in the business. So I do think it is going to stay. I do think it's going to be really complicated for fintechs to navigate this, and here's why. All the responsibility on risk management rests with a bank. So you, the fintech, could be the best compliance risk management fintech out there. You may have the best culture, the best consumer protection, you may have like everything top of the line. But at the same time, if the bank cannot translate that to the regulators, they're not going to pursue that relationship. And the other thing that's really complicated, and now I have had a few clients in this situation, is that the fintech will say, the regulators are asking X, and I give X to the bank, but I don't know how the bank is going to translate X to the regulators. Can I speak to the regulators? And quite often there is hesitation for the fintech to go directly to the regulators, and if you ask the bank will say, heck no, you're not speaking to my regulators because I don't know what you're going to say. So it is really complicated to navigate this, and I'm afraid that, as I mentioned, is going to have the chilling effect. So, but back to the original premise of your question, what's the message here? I think the message is clear. I don't think that the current set of regulators really want banking as a service and third-party partnerships to, blossom per se. I do think they can't specifically prohibit them, and I do think they're trying to make it more difficult for banks to engage in those partnerships, and they're carefully monitoring compliance and risk management at banks to make sure that the risk you're taking on as a bank is commensurate with what you can handle. And I think if you go at the consent orders issued by the OCC and the FDIC over the past year and a half, about a year actually, you will see that if the regulators don't think that you can manage the relationship, they will ask the management to step in and quasi-manage the bank. the board to step in and quasi-manage the bank, which is not exactly what boards are meant to do.
So that consent order that you're referencing, and we're aware of another bank that's about to get one, are BSA, AML, KYC related, or that seems to be the biggest part of it. Is that something where there's an expression in Texas, if you hang the meat too high, the dogs won't jump? Is that something that is meant to say to banks, you're not going to be able to comply with this? Or is there a eye of the needle that banks can thread on the BSA AML issues?
Sure. And you should know never to use idioms like that with a non-native speaker. They could mean anything if you translate them literally. And in Texas,
How
they
would
can
you
mean even
translate
more.
it?
I don't even. Probably not appropriate for the audience. So I would say that the message that is being sent by this is that your every step is being watched, and it's not going to take a lot for you to get dinged on BSA AML. And by the way, most banks have BSA AML issues, not because they don't have good compliance and risk management programs, but because that stuff is hard. And when you're trying to, especially if you're playing in a space where the unbanked and underbanked consumers are, when you go and you try to onboard these consumers, there's a reason there's not a thick file on them. There's a reason that they are unbanked and underbanked. So when you go to onboard them, the risk of onboarding that customer is even higher. But if they're not served, then the very premise of what we're trying to achieve in the United States, which is to bridge the income gap and the wealth gap, is not going to be fulfilled. So I do think it's a little bit odd that the very same people who profess to be in favor of financial inclusion and low and moderate income communities are really making it hard for those communities to be onboarded with banks, and not creating on the regulatory side some programs that would help banks and fintechs onboard those consumers.
So it's kind of interesting because it seems like on the entire compliance side of things, it's never prescriptive. It's never, this is how you do it. It's always principles-based. And then when you get to areas where there could be gotcha, now there are rule books, and an area where that's apparent is the FDIC just came out with principles of corporate governance. And so traditionally, corporate governance was state law. It was principles-based, based on fiduciary duty. And now the FDIC has a lot more prescription around how you provide corporate governance, board oversight, including things like the board has to evaluate diversity and explain why it doesn't go a certain direction, which again is kind of check the box. What's your take on these new rules on corporate governance?
Yeah, I think they're misguided, and here's why. To your point, Peter, it used to be handled through, state regulations, and there is a long-standing law that talks about corporate governance, et cetera, et cetera. The reason that I think this is misguided is because it kind of, and I don't want to take this too far, but it kind of codified in guidance what has been stated in these enforcement and consent orders by the FDIC. Basically, it's putting the management again into the board into the role of management in how you conduct this. If you think of a small bank, and again, most of these banks are under $1 billion, and the vast majority are actually under $500 million in asset. That's a very small bank. The banks don't really become really profitable until several $100 million. So when you really think about, depending on the risk profile and the business model, so when you think about it, if you're asking the board of that bank, and who sits on the board, it's the local, warehouse store owner and the
There's
postmaster.
always a dentist or a doctor.
Yeah, there's always a dentist or a doctor. Yeah, they make it painful. Thank you. I like this table. These people are not highly sophisticated in corporate governance. They're just trying to do the best for their community, which is why they agreed to serve on that bank's board. And by the way, the bank's board don't pay much. So there's a lot of risk and liability. There is low reward financially, so to speak. And so really in these communities, why do you serve on the board? You serve on the board because you care about the community and you want this bank to do well. So what I think, the reason I think that guidance is misguided is because it does place way too much emphasis on the board vis-a-vis the management, and I think it's going to discourage sensible people, business people, to sit on the boards of these very small banks. And again, you want these banks to continue to exist in the United States of America, and this is not the way to do it.
So you've been on the other side of the curtain. Do regulators talk about if we do this, it's going to dissuade people from serving on the boards? Is that part of the decision mix at all?
Well, I did when I was in my chair. I don't know if they still do. But by the way, if they did, I don't think they would put this out. I think there has to be a way for people to be encouraged to serve on bank boards. And you want accountants on bank boards. You want people who actually care. But everybody who actually understands the risk will say, why would I do this? I might as well go and sit on the board of like a widget maker, right? Well, it's so much easier, and I get free widgets, so why not?
So another area where we've seen this shifting in philosophy is within the FDIC. You created an independent appeal process where if banks didn't like the examination results because they thought the examiners were just wrong, they could appeal independently. And one of the first things that your successor did was eliminate that and go back to what was the SARC, which was where you took appeals. So I guess, is this more of the same shift in philosophy? And then separately, do you think the SARC is for banks that are like the 2/3 of banks that are regulated by the FDIC? Do you think if they're convinced they're right, that they should still appeal to the SARC?
Yes, and SARC stands for Supervisory Appeals Review Committee. So yes, I believe that the regulation and supervision should be data-driven. It's shocking, I know. And if you look at the data points on bank appeals of their supervisory findings, there was an Inspector General report for the FDIC, and I think it covered years 2012 to 2015. It was a 4-year period. And you can find this IG report. It's buried someplace in the FDIC IG archive. And that report basically took a look at 20,000 exams over a period of 4 years. And of the 20,000 exams that were undertaken, supervisory exams, 30, I think 1 or 2 were appealed by banks. Of the 31 or 2 that were appealed, 2 were ruled by SARC in banks' favor and fully and 1 partially. So out of 20,000 exams, you're looking at 2 successful appeals and 1 partially successful appeal. And so when I went around the country and I talked to the community bankers and I said, you know, how do you, are the examiners fair? Are they conducting themselves in a manner that you can appreciate? I said, I don't mind them being tough, but they need to be fair. And, even if the bankers thought that the examiners were not fair, they would not appeal the decision. They said, because they're my judge and my jury. So I thought creating an independent body outside of the FDIC to review these appeal requests would be beneficial for the industry, frankly, but not in a way as a giveaway to industry. It was just level the playing field so that they have a fair assessment and a fair approach. So that was killed, and we're back to SARC. I do think you should appeal, and here's why. Even if you're a small bank, I have had, like when I was in my chair as the FDIC chairman, we have had very small banks appeal decisions, and they would literally do everything by themselves. They didn't hire outside counsel. And
that's a shame.
No, it's the right thing. Come on, I'm the worst business development person, so it's a good thing they didn't have a lawyer. I'll tell you why. Because they showed up, they had nobody there. It was clear they did an appeal in-house. And as a chairman, I realized that they're so fervently and passionately convinced that they are correct in their thing that I would actually give them extra time, because they're such a small bank that I didn't think they would have the resources to go and hire one of our law firms, et cetera, et cetera. So there's a lot of sympathy, at least with me, in my prior job, for banks that would appeal, because obviously, if you put in all the effort and time and money behind it, and you show up in Washington to plead your case and face your supervisory examiner, You must believe you're right. But the reason I really think you should appeal and be encouraged to come to SARC is one is substantive and one is technical. The substantive reason is this. If you don't, depending on what it is, and the supervisory decision stands and it leads to, say, a consent order, good luck getting out of that consent order.
Okay.
And it is really hard. It takes years. And by the way, if you get one consent order, you know what will happen? Your management rating may not look good. And if that management rating does not look good, your overall rating may not look good. So it's like a waterfall. It's not just about that supervisory decision that you want to appeal and you're not sure if you should. It's the waterfall of decisions that are going to happen along the way, and they're just going to degrade your standing. And by the way, when your CAMELS ratings go down, your deposit assessments go up. And good luck opening up that new branch or merging or onboarding new fintechs or third-party service providers and services. So I don't mean to paint a gloomy picture, but I do think you need to fight for your rights. And so that's the substantive reason. The technical reason is that, and here's a little thing people don't really know. So the SARC consists of 3 members. 2 are, it can be either one of the, it can be either of the 3 directors from the board of directors of the FDIC, so the sitting directors, and or their designates. And so currently what you have is you have 2 Republicans sitting on that SARC and 1 chairman's designee. So if you have a viable claim that the process might have been violated, or you're not sure that the examiners acted in good faith, etc., I do think you're going to have a somewhat sympathetic ear. And what you need on the SARC is a 2-to-1 decision. And I think that the current setup of the SARC is probably the most conducive, if you have a legitimate case, for you getting that 2-to-1 decision.
So people have commented that the FDIC is now politicized. You're seeing dissents from those Republicans. Is this a trend line we're going to expect to see in the future? Are the dissents of any value to changing the course of the FDIC? It used to be more consensus-driven, certainly under your leadership.
Yeah. Well, I had a constant dissenter, so I don't know.
One, yeah.
Yes, it was very predictable. So I will say that it's unfortunate that the agency got politicized. It got politicized while I was there towards my very end, when the other board members wanted to assert their agenda on bank mergers, and I disagreed on principle and substance and law. And then I left, and they have changed the bylaws since to allow any board member of the FDIC board to bring up an action item for a vote, so long as they bring it to the chairman's attention 2 weeks in advance. So, but what they really did with the request for information on bank mergers, which is what we disagreed on, was subject the agency to the executive order of the president. And for 89 years prior to that, the FDIC was an independent agency, basically not subject and not following executive orders of the president. And why? Because you don't want every 2 months, when a new executive order comes out, for the agency with supervisory powers that basically controls the, frankly, livelihood of many Americans by the supervision of banks that provide financial services. You don't want it to go like this, because banks can't adjust, right? So once you change your compliance system, it'll cost you, $200,000-$300,000 if it's a small change to change your compliance system. And if you do it here, and in 2 months, 3 months, the president decides to do something different, and now you have to spend another $200,000-$300,000. And for a small bank, again, it's prohibitively expensive. So you want to keep politics out of the independent agencies, and they subjected the agency to the executive order of the president on bank mergers through that RFI. So they broke the 89 years of precedent, and now the FDIC really can't say, oh, we never follow the executive orders of the president, we're not political. Now they are. And that's actually unfortunate for the agency. Doesn't, I encounter people who say, oh, I'm so sorry how you left and what they did. I was like, don't worry about me. America has been good to me. I'm great. The truth of the matter is I feel for the agency and the loss of that independence, and having been born elsewhere, I know what happens when you don't have agencies that are basically apolitical and that are subject to the political machinery, whatever that is. So that is the problem, frankly, and I don't see that changing over time.
So
Did anybody tell you this was going to be a positive session? That's the next one.
So shifting focus a little bit, so we wound up with a 40% growth in the money supply, $2.5 trillion of excess deposits that we're seeing about half of that leave the banking system. So banks are struggling with liquidity issues. Is there something the regulators should be doing to help the banks in that regard? Because obviously, without the deposits, there aren't the dollars to lend, and the entire economy works on small business and consumer lending.
Yes, there is quite a bit that they could be doing if they wanted to work in a very collaborative fashion and engage with the industry, which I don't think they're doing right now. So what happened during the pandemic, federal government pumped all this money into the economy, you all know this, and what we had to do at the federal agencies, banking agencies, is figure out a way for us to allow all of this incredible increase in the balance sheets and the increase in deposits to somehow be managed in a way that doesn't hurt the bank. And as you can imagine, the liquidity coverage ratio and a lot of other things just were really, this is a professional term, they went out of whack. And so as a result, we were looking at different things, how to help banks. We issued a number of guidance documents and suspended some of the regulatory requirements on capital and liquidity. We encouraged banks to dip into their buffers. We took some stuff out of the denominator for the liquidity coverage ratio so that the banks can have an easier time managing the deposits. But the truth of the matter is that the federal government encouraged banks to take on these deposits. When money was through PPP and other incentives from Congress, when money was sent out to the public, basically many people didn't have checking accounts. And so we encourage banks to open up the checking accounts, make the small business loans, do this, do that. And as a result, banks, and we've said at the time, so long as you follow prudent, risk management practices, et cetera, you're not going to be penalized for this. Now you're seeing banks being penalized for exactly what the government encouraged them to do. And now the rapid outflow of deposits once the economy stabilized is basically threatening the stability of these banks. Not to mention, and we don't need to get into the bank failures, but managing interest rate risk in the current environment is really difficult. If you've been reading the headlines, you know how difficult it is. So I do think that there are steps that the regulators should do. Take a look at how they stress the portfolios of these banks. Again, revisit the liquidity coverage ratio, revisit the simple leverage ratio for these banks that have the simple leverage ratio. Figure out, do we need to ameliorate some of the requirements that go into the numerator and the denominator for these formulas. There are different things that can be done. The question is there political will to do it?
So speaking of political will, and I think we have just one more question. After the bank failures, there was an effort to try to get a temporary liquidity guarantee program where all checking accounts at all banks would be insured. And Congress didn't seem to have the political will to pursue that, but really the regulators didn't pursue that. Is that something you think would be a positive? Should that be part of the mix, or it's not really needed?
So I took a position, and I tried not to comment while everything was unfolding, so I didn't make any statements, I didn't go on TV, et cetera, et cetera. I took the position in the aftermath several months later that perhaps it wasn't necessary. Not a blanket increase in the deposit insurance limits, and here's why. For several reasons, but the main reason is this: banks pay for this. So the deposit insurance is not free. So there's a deposit insurance formula, there's the complex banks, large banks formula, which looks at the risk profile of your portfolio. It assigns different risk weights to different assets in your portfolio, and then it gives you the formula for the deposit insurance assessment. For small banks, it's a little bit more simple, but it's not a small amount that these banks, and as I mentioned earlier, your CAMELS rating will affect how much you pay as well. And so when you look at the unlimited deposit insurance, it's not that I have feelings about it one way or the other, or I think, it would be good or not. Of course, it would be good to insure everything. Why not, right? But who's going to pay for it? And I think that, this is where rubber hits the road. It would be great to have a lot of things, but I spent a little bit of time in the United States Senate, on the Senate Banking Committee and Senate Finance Committee, and when you spend a little bit of time on Senate Finance Committee, you understand there's no free lunch in the United States of America. Usually you have to borrow that from your classmate and then call it the free lunch. So the truth of the matter is that I do question how banks would be paying for this unlimited insurance, and you certainly don't want taxpayers on the hook for it. So I do think technically it would be problematic. Now, if they want to deal with payroll accounts, if they want to assign, different insurance coverage to specific business accounts, perhaps that's a good thing to do. But I do think it's a little bit complicated. And also, for so many years, the FDIC, for decades really, the insurance limit has changed, but for decades the FDIC, rests behind the no depositor ever lost a penny of their deposits, insured deposits. And that deposit, there's a sticker by law prescribed that has to go in the bank, and it says whatever, now it's 250,000. It would be really hard to explain. You're all insured up to 250,000, except, Tom, Dick, and Harry. They get $1 billion in insurance because they have payroll accounts. So I think it's hard to communicate that message. So that's why I came in favor of probably not necessary, but I do think that banks with a high percentage of uninsured deposits need to manage their liquidity differently, knowing that money will run. And I think what Silicon Valley Bank in particular showed us is that the difference between, it used to be that broker deposits are hot money, they run. As soon as there is a sign of trouble,
They didn't run.
It was the other deposits that ran. So it is really interesting how things kind of played out. I do think there is a bigger post-mortem than just what the agencies have done. That should be policy-based, not just fact-based, as to what happened at these banks.
Please help me recognize Jelena McWilliams.